Hi, welcome to Financial Education for the Nation. My name's Warren Shute, and I'm here with Paul today. Slight different format in today's presentation or recording. That we're going to talk more about a conversation style about an article that Paul's written for the site on cryptocurrencies. So, how you doing, Paul?
Yeah, I'm good, thanks, Warren. I'm good. Yeah, so this has been in the news again recently. A huge amount of media attention last year, and then it's come back for all the wrong reasons, I guess. That the value of them has fallen massively over the last few months and the last week in particular.
Yeah.
So, I mean, where do you stand on cryptocurrencies? Because last year, in the run up to Christmas, the value was going through the roof. The media were all over this. It was everywhere, and people were really fear of missing out. People were really wanting to get involved because this thing was just going up like a rocket.
But what a great financial lesson in real life, that the investment is running away and you're not a part of it. So you're not part of that team. You're not in that inner circle. How are you feeling? You know, it's an interesting one, because you can see, or at least you read about, some people making money. Our brains are fantastic machines at generalizing. So therefore, what we do is we generalize, think everyone's making money, but I'm not, so I'm missing out. So I need to be part of that. And then you jump in. But what's happening really is the smart money is like saying, okay, now it's at a peak. When I've jumped in, let's offload. And that's when the market starts coming down. So
right, so the smart money got in early and then got out when everybody else started putting their money in.
I'd say some of the smart money did. Yeah, we use this term smart money, and we have this, when I say smart money, a lot of people listening will have this image of this very wealthy, sophisticated trader sat in the Bahamas or something, trading this cryptocurrency, making money on the back of all these poor people. But they lose money just as much as everybody else. But what they've done is they've learned lessons. And they've tried to train their brain in such a way that we don't get in at the bottom, we don't get out of the top, we accept some of our investments make losses. So I think the psychology of the fear of losing out, which we're all affected by. I was affected by it as well. You're sat there thinking, God, everyone seems to be making money on this. My brain is generalizing, and I have to have a good talking to myself and say, no, they're not. No, they're not. Is this a sound investment proposition? And that's where it differed for me. It wasn't, or still isn't, a sound investment proposition. Just like I don't bet on the dollar sterling or dollar euro exchange rates. It's a bet. When you're buying cryptocurrency, it's a bet.
Okay, so do you generally then, you'd say, you mentioned earlier kind of lessons for the wider financial sphere, and just tie it in with a bit of that in terms of an investment strategy and how it differed, because from September to December, the price went from kind of $5,000 to $19,000-$20,000 per Bitcoin. This week it's dropped to just over 6,000. So if you got in December, you're now holding something that's worth over three times less than it was. Investing isn't about get rich quick, is it?
No, it's not. But hey, look, you're not a bad person if you invested in cryptocurrencies. Okay, it has its position for everyone. It's just like going to the horses or the dogs. If you place a bet on the horses or the dogs, you're not a bad person. You do it for the entertainment and the enjoyment. You have fun. My wife loves it. Okay, it's not my kind of thing, but she loves it. So it has its place for everyone. But let's not get confused. It's not an investment. Okay, so we certainly don't do it with the intention of making money. We do it with the intention of enjoyment. Okay, so that's our outcome. We're doing it to have enjoyment. And we always make sure we only risk as much as we can afford to lose. So it's not an investment. So your investment philosophy should be based, and the most important thing is you have an investment philosophy, an investment strategy. That you might think, I'm just putting into my workplace pension. Why do I need an investment philosophy? Because when things go wrong, you need a user manual to go back to and read it and say, no, I thought something like this was going to go wrong. Warren said something like this will go like this one time. This is how I said I'd react when everything was fine. This is how I'm now going to react. So it's important you have an investment strategy or investment philosophy that you've written down when things are calm and sound, and that you keep to it. And an important investment philosophy for your retirement, for example, would be How long are you going to invest in? What are you expecting your portfolio to fall at the biggest fall, the biggest decline? How are we going to invest our money? Are we going to invest it just locally? Are we going to invest it internationally? Are we going to invest just in big companies or small companies? Do we use index fund or managed funds? You've got to iron these things out. And what would be a good idea, actually, is maybe if I put some key pointer questions on the warrenshute.com site, so people can look at that and think, okay, this is my investment philosophy. That's for the bulk of your money. If you then want to take a punt on cryptocurrency, do so for enjoyment, but it's not an investment.
Okay, I mean, because it's interesting, you just highlighted there, it's complicated in having an investment philosophy and strategy, unless I have someone like you on my side who's helping me look out for that stuff. It's complicated. I think one of the big draws about cryptocurrency was constantly in the headlines, this thing is going up and up and up and up. And it was really easy to understand. If I can get hold of some Bitcoin, which isn't that simple, wasn't that simple in itself, I can watch its value go up and then I can sell it and get out when I need to. That's a bit different than investing in the markets and the strategies that you've just talked about.
Well, that's why I like these online providers who give you an investment solution as opposed to selling you the next best fund. If I can give you one message from this video, it's when you invest and you invest it yourself, don't buy a fund. Make sure you provide an investment solution, a portfolio. So at my own site, Lexo, lexo.co.uk, and there are other sites, Vanguard, I think Nutmeg as well, give you a solution. So they give you a portfolio of funds that you can go into and you can buy. And they've been put together intentionally because they balance each other out. And that is an investment strategy, an investment philosophy. So they've been put together for you. There are other providers out there who won't mention their names who say to you, this is the next best fund. This is the best. I've even heard the funds called the best of the best. And just stay away from those. You know, that's not investing. That's gambling. That's just, you know, it's just not worth your time or effort. And that's when you have a bad experience with those type of investments, you then generalize, your brain generalizes again and says, oh, all investments are poor. You can't make money in the stock market. And that's not true. On my site, I'll give you, I think, almost 20 years of data of what the performance has been. It's not always been positive. We show you the ups and the downs and how it's done. And people have been very pleased with it.
Okay. So coming back to cryptocurrencies, it's interesting. You say they're not an investment. You describe them then as a commodity. A
commodity, yeah. So an investment has a definition of it. It produces something. So if we look at a company, for example, most companies make a profit and they may share some of those profits often through dividends. So that is an investment. The price or the value of that company is dictated by its profits and its earning power. That's an investment. If you look at a house, a rental property, you buy a property, it's rented out. The value of that house, whether it's a house or a commercial property, is often dictated by its rental power. So how much rent can I get? What yield is that as a percentage of the property? They're investments. When you look at something like gold or a cryptocurrency or oil, that doesn't produce anything. It goes up and down based on people's desire to own it. And that's not something we can really have any control or there's no structure around it. You know, people are run up to Christmas, but people were frenzied about Bitcoin and all the other cryptocurrencies and just plowing money in and it was going up, 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 up. And when they're not so happy about it, it just goes down. We don't know with any structure what's going to change that. Now, what's going to make it go back up? Well, people wanting to buy into it. But, you know, we don't know when that might be.
But you could say the same thing about the stock market. No, we don't know when that's going to go up and down.
Yeah, because no, because what actually happens is a company has a value. Okay, so its value is made up of its assets, so its buildings, its cash reserves, and also its earnings power. And there are formulas where you can actually value the company. And if that share price keeps falling to such an extent that the share price is lower than its per share value, well, there's a lot of wealthy people out there. If you start seeing something like Apple start falling in value and you think, hang on a second, I can now buy the whole of Apple and I can buy its bank account balance, all its assets, and I own the whole thing, well, I'll do it. That's what keeps the share price buoyant. It has an intrinsic value. You can look at houses. You know, if the house price keeps falling and falling and falling, but actually the rents are quite good. So a typical rents are about 5% typically. But if the house value keeps falling, so now the rental value is, say, 30%, well, people are going to start taking all their money out of the bank and just buy property because they can get a rental value of 30%, and that will take the price back up again. And same with shares. If share prices keep coming down and the dividend that they pay out starts becoming 10%, people go out looking and think, well, I'll take my money from the savings or my cash that I've got and place it in this company because I'm getting a 30% yield on it. So there's a difference there. It's producing an income. It's an asset as a value. And great companies, likes of Apple, Microsoft, the likes of these companies that sort of now have so much an influence over the running of the world, aren't going away anywhere soon. They have users. I don't know if you've noticed, the new business model isn't buying something, using it. It's almost leasing it. It's subscription based. So they have a regular reoccurring income. I'm often getting my iCloud. You're running out of space. You need to upgrade, pay a little bit more. So you constantly pay a little bit more to these people. So as a consumer, we have to keep our controls on those. But as a company, that's a great revenue stream.
Okay, let's just come back to that investment strategy and philosophy, because as we've already touched on a few minutes ago, media headlines drove a lot of the frenzy about cryptocurrency and Bitcoin in particular, as it was at the time, and suddenly more people are hearing about it. And I remember my LinkedIn feed, there were people discussing openly on there, should I be doing this? Am I going to miss out? And other people saying this isn't something to get into now. Everyone's got in when they should do. How much? Sometimes it's quite difficult to not be influenced by those outside factors. You touched on it earlier, that kind of fear of missing out of everyone else is making money.
Yeah.
How do you almost insulate yourself from that when you do have a more steady approach and you're more market-based in your investments?
Don't watch it. It's a simple answer, but in the profession we have this thing called financial pornography, and it's basically the headlines from people like the news and the media of saying, the next best thing, or it's different now, or the world's changing, or this, that, and the other. Just ignore it. So it's easier said than done, but let's face it, it shouldn't be called news, should it? It should be called bad news. Very often they sort of portray images on the BBC News headlines of companies that are doing particularly well, new people being employed, medical research being a winner. It's normally at the back end. We get all the bad stuff at the front. And when the markets start tumbling and the volatility picks up, that's normally the leading story. So if you find yourself affected by it, then you shouldn't watch it. It's the same if you are a recovering alcoholic. You don't socialize with people who drink a lot, because you'll be affected by it. There's similarities around it. So what I would say is, if you've had a bad experience with investing because you change your investment philosophy every time you hear someone say something new, okay? It's like a dieter changing their diet every week because they're going to go carbs, no carbs, vegan, paleo. They're just going to keep swapping Weight Watchers. They're going to keep they don't give any one of those nutrition plans or those diets any time to succeed. Whereas actually in reality, if you start with any one of them, they probably would do very well for you. It's the same with investment philosophy. Get an investment philosophy. So your investment philosophy might be very simple. It might be, I've got 15 years to retire, or 15 years till I need access to this money. I expect this investment to fall by 50%. Therefore, I'm going to invest 100% in a globally diversified portfolio, because I don't know which country around the world is going to do tremendously well next. I'm going to hold it, and I'm going to review it every 5 years, period. That could be it. That could be your investment philosophy. It's very simple, very clean. You could go one step easier, and you could go to a site like Lexo or Nutmeg or Vanguard, and you could look at their range of portfolios and say, I've got 15 years till I need access to money. I'm going to expect this money to fall by 50%. I'm going to choose the highest risk portfolio, because I've learned over time, more risk will give me more return if I accept the volatility. Now, if you're closer to retirement, say you've got 5 or 7 years out, you might do the similar thing, but you're going to say, well, look, if it fell by 50%, it's going to take too long to recover. I want to make sure I can retire. So I'm going to put a cushion in there. Maybe a 10% fall isn't acceptable, but it's tolerable. I don't want it to fall 10%, but I know I have to take some risk. So I'm going to choose a portfolio that's commensurate with that downside, that risk level there. And if you go onto Lexo, you can click on each individual portfolio and it tells you the worst 1 year return. So you can say, okay, well, historically, that's the worst this portfolio's ever done. That sits about right. Now, that's not necessarily the worst it will ever do because we're investing. But with the financial crisis in 2007 and the dot-com correction in 2000, they're two significant drawdown periods in the market. So we're fortunate that we have this good data to look back on that could give us an indication of what the future lies.
And I think that's really important when it comes to Bitcoin and Ethereum and Ripple and the others, that it's not just about that frenzied 3 months at the end of last year, but if it starts going up again, because it's down to 6,000 now, who knows? Maybe it'll go up to 30,000, even ahead of the 20,000 mark in December. It's important to remember the fall as much as it is to have all these headlines bombarding you with the growth of 300%.
We are more affected by our losses emotionally than we are our gains. You will do more to keep me from taking £10 from you than you will from me giving you £10. You'll protect your money. You will, because that's what people do. And when our money goes down in value, we are emotionally affected by it, and we think differently. And that's why it's important to have a written investment. I call it a philosophy. Let's call it a statement. Let's call it a plan, a written investment plan. This is my plan that I plan to do. This is my expectations. It's very funny when talking about this. It reminds me of a conversation I had with a client probably November, December last year. And he's in IT, and we're going through his net worth statement. And he said, "Oh, I forgot to tell you, I have some Bitcoin." My eyes looked up. "When did you buy those?" "Oh, years ago." "How much do you have?" "It's about 80,000. "How much do you invest?" Only a couple of £1,000. "So you invested 2, and it's now 80. "Yeah, about that." "What do you plan on doing with it?" "Well, I did. I was going to ask you." "Sell it. Sell it. Get out of it." So get out of it. Bank it. If you want to keep the journey going, keep a 3 or 4, £5,000 in there. So you're in the game. You know what's going on. But you don't need to hold that level of money relative to your overall net worth. Now, I see my clients typically yearly, so I haven't spoken to him since, but it'd be interesting to see if he did get out in late November, early December, or whether he's now probably back to a similar sort of level as what he invested originally.
Yeah, sure. Interesting to see.
Yeah, it will be interesting. I might even drop him an email after this. So if he might be watching this, and he might want to DM me and just say. So.
All right, good stuff. I think that's a nice way to end. Thanks very much for it.
Thanks, Paul.